Good morning. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor. Here we are, first week in November, and the equity markets are on fire. We have the S&P and the Dow, NASDAQ at new highs. NASDAQ new highs since 2000, so it's still working on taking out its 2000 high, but the other indexes are up at their highs, as are the Dow's Transportation Index. And it was a pretty stunning sort of V-shaped recovery, so that's pretty interesting. So what I'd like to do is take a look at what's really driving the equity markets. Well, first off, we have to take a look at earnings. So far this quarter, out of like the 360 some companies that have reported on the S&P 500, 78% of them have beat analyst estimates. Coming into October, the consensus estimates, they're looking for a growth of about 4.3% on the S&P, and so far the growth's been 7.3%. So that's really pretty good. Now, as far as valuation goes, looking forward, the market is still very fairly valued. On a forward PE, we're looking at the S&P of about 15.2 for next year. So not overvalued by any stretch of the imagination. Now, corporations are flush with cash as well. At the end of the last quarter, it was recorded they had 1.35 trillion in cash that they can use to make investments once they feel the economy is a little bit more on solid footing and good policies coming out of Washington. Also, what we have going on is new technologies that are holding up this market. Technologies such as fracking, making energy very abundant, as we saw oil prices fall. We have 3D printing, we have smartphones, we have the cloud, we have apps. So all these things are helping sustain the economy. Now, most of all, we have an accommodative Fed. Now, most people will argue that the market was in a sugar high, just led by QE, but all this year, at the end of last year, we were told there'd be tapering, and sure enough, it happened. There's the end of QE, yet the markets did pretty well. Now, of course, on Friday, the Bank of Japan embarked on their own form of QE by announcing to purchase more assets, so that gave the market a pretty good shot in the arm. But I don't really think that has too much to do with what the U.S. markets won't affect it too much, but it will in one way, and the way is that it made the dollar stronger. Now, with the dollar stronger, it puts pressures on commodities. And commodities, if they're cheaper, it's lower input costs for U.S. manufacturing. And we saw this morning the ISM manufacturing index came in at 59%. That's the second highest in 5 years. And that's really a high number. Analysts were looking for about 56.6%. So we got to say a little bit shot in the arm for Japan, but in a roundabout way. But the point is that we have good growth, low inflation, a strong dollar, so equities are a place to be. Now, out of all the, and also one of the other things we want to consider is the election tomorrow, November 4th, midterm elections. It could be that the markets are looking for a change in Washington, and they're discounting this. That could also be. And basically what we're looking for is better policies out of Washington, low taxes, strong dollar, and lesser regulations. Now, looking at all the sectors and the industry groups that are acting well, I look at the IBD. They track 197 industry groups. And if you look at the top 40, we have 10 of them are in the medical industry groups. About 7 or 9 of them are in technology. We have transportations groups also occupying that spot as retail. So we have good growth groups in the top 40 groups out of all the 197 industry groups that tell you this market has some legs and it could go for a while. But as always, don't take my word for it. Let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor, and good luck trading.